Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president and financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome. Thanks for being with us. I'm Chris Boyd. I'm here with Russ Ball. We are of the AMR team, Wealth Enhancement. Glad to have you with us. As always, it is the holidays, the high holidays on Cape Cod. Finally, we've got the time of year we wait all year for. It's the 4th of July weekend coming up, and very excited for that. So, Russ, thanks for being with me as Jeff Perry is on a vacation, a well-deserved vacation.
Absolutely.
And we are dubbing this episode At the Half. So we're going to talk about what's going on in the markets at the halfway mark. But before we do, you doing anything fun for your holiday weekend?
Well, I'm actually heading on vacation next week myself.
That's right.
I'm heading out. I'm going to be in Texas for 4th of July.
Excellent.
So I think first time.
Gotta imagine they do it up big in Texas.
Yeah, I would think. Everything's bigger over there. So I usually do 4th of July. I've done 4th of July here, I think, almost my whole life on Cape Cod. So it'll be different, but I'm sure it'll be fun.
Excellent.
Yeah.
I figured I tried to wear a little red, white, and blue for my effort here. That's why I'm
the little whale there.
I do have, you can't see it there, but I got a little patriotic flag there too. In any case, trying to be mindful of our patriotic season here with Independence Day on the horizon. So, well, thank you for being with us. Let's jump into talking about where we're at. What a volatile year we've had thus far with sort of a market roller coaster. And we can talk about some of those drivers, but clearly tariffs have been one of those big drivers. We, as of the time of this recording, we are in the midst of the one big beautiful bill has now passed the Senate. It awaits reconciliation in the House, though seems all but inevitable. I mean, you never know, but seems likely it'll get pushed to the president for signature in the night, perhaps by the time this episode is being heard. So in any case, there's been a number of things, that have been, and then of course we've had more recently, we've had increased geopolitical concerns with what's been happening between Iran, and there continues to be, stress in the world when it comes to Russia and Ukraine and Israel and Hamas and all of the efforts there. So in any case, lots of things to be focused on. It seems that markets have had less worry as time has passed, in part because of the delay of the imposition of these proposed tariffs. We are now at a point where we're getting close to the end of the first 90-day period that was proposed to try to get some clarity around deals with other nations as we try to iron out some sort of tariff, renegotiate tariffs, trade arrangements. What will happen in early July? I think it's July 9th or somewhere thereabouts that the 90 days expires. I think it's widely expected that there'll be another extension of time to continue this process. At least that seems to be what the market is expecting. And as of the end of the quarter, markets are up. We have had, I think we went down near 20%, just shy of 20% from
19% on the S&P
from the highs earlier in the year to the lows. But as of now, year to date, the S&P, this is as of the end of the quarter. Thought this would be a best way to talk about numbers through June 30th. The S&P 500 is up 6.25%. The Dow Jones Industrial Average is, which is only 30 stocks, but and it's the composition of the calculation of the performance is done differently. It's a price weighted index as compared to a capitalization weighted index. So that don't know if that makes a difference, but it is one of those things that it's a little bit different in the way it's structured. It's much more narrow, but that's 4.75%. And of course, the NASDAQ composite, which is different from the NASDAQ 100 in some modest ways, but it is significantly higher at 10.3%. It is tech heavy. The NASDAQ composite, if we use something along the lines of the QQQ ETF, somewhere around 7.9% would be the estimate there. That being said, I'm not sure if that incorporates dividends or not. So that might exclude some of those kind of considerations. So in any case, up markedly when it comes to the U.S. stock market in different parts of the market. I think that might imply a little bit better returns from growth than value, if we want to talk about it in those terms. Russ, maybe before we go on to talk about foreign markets, would you share some thoughts about what maybe from JP Morgan Asset Management had shared some details in one of their reports?
So really looking at the charts from JP Morgan, it looks like year to date, the large cap just across the board have really been outperforming. It looks like 6% for value, 6.2% for blended, and 6.1% for growth. So pretty much across the board. Mid cap is a little bit different in terms of their performance metrics. Definitely growth is winning out over value, and same goes for small cap, but to a lesser degree. And really only small cap seems to have underperformed so far year to date.
Which is in line with what Brian Regan, our team's senior portfolio manager, said. And by the way, Brian's not with us today. We had talked about him being with us, but he did send along this message.
I'm all fired up, so it should be a fun show.
All right. Thank you, Brian. Teasing. But we will have Brian with us next week. He's on vacation, of course. It's perfect time to be on vacation.
Absolutely.
So in any case, and when we do have him on, we'll talk a little bit about some views about market exposure, what to think about as we look ahead, some of the things we're thinking about as we're considering. But this is a really stressful time about how to be positioned, because as we're going to talk about, at times it feels like the market's extended in certain parts of the market. If we're looking at PEs, but Brian often is an advocate for not looking at PEs and looking at other metrics. So we'll talk about that more today. What do you think PEs are telling us?
Well, again, looking at this chart, so pretty much across the board in every category, large cap, mid cap, small cap, value, growth, you name it, we're at about peaks for not peaks, but at least meeting the 20-year average. So most part well above that. So
yeah, I mean, let's walk through that a little bit. When it comes to large cap, everything is between 120 and 140, 50 almost % of its 20-year average PE figures. Now, I think Brian would argue, and I don't want to speak for him, we'll let him do that, but I think he would argue that the economy has evolved over that period of time, and that there's more technology, and that there may be good reason for some of those extended PEs in certain parts of the market. Causing me concern a little bit as I look at this, but there may be pockets where there's more opportunity. But generally, when we think about what would be my ideal for buying, it would be when valuations are considered to be at a discount,
below their average.
Below their average, right? All of these are either at or above, and maybe notably above it's certainly on the growth side, above their average. So that's an issue. Let me go to another part of that graph. That presentation. This is from the Guide to the Markets that JP Morgan produces each quarter, and one of their slides talks about the 30-year average. The 30-year average of the S&P 500's forward price to earnings ratio would be around 17 times earnings, and we're at around 22 times earnings if we put it all together. That just seems high. And whether or not that's a reasonable assessment of how to make a assessment of valuation, we'll talk more about next week. But that's an issue, that I think we have to keep in mind. One of the considerations, at least. You were talking about this a little bit.
Yeah, I think, we were having this conversation on the podcast and with clients at the beginning of the year when valuations were pretty much where they are once again. So we dipped down in April due to the tariffs, and things sort of, the valuation discussion kind of left the picture a little bit, and the PE,
because they discounted some.
Yeah, it was a little bit more in line with, still, I'm looking at the charts. It was still well
times,
above the average.
Yeah, 20 times instead of 22 times, but still it went down from where it was.
Right. And now we're back.
There were a lot of concerns because of these other variables. If you suddenly have one of your largest trading partners barred from interacting with the trade.
Yeah.
I mean, it's going to have, thinking of China, that has a huge impact. Now, maybe that concern has diminished when it comes to making trade arrangements. It looks like there's going to be some meeting of the minds. For the most part, we had just last week, though, we discontinued talks with Canada. I don't know if that's improved since then, but there was a headline about, that's it. We're leaving the table, It's like, what is Canada's one of our biggest for first or second, I think, trading partners.
Yeah.
I mean, how do you not come to terms?
Right. And I mean, I think the idea was, it's based on the rhetoric of the administration, it sounded like there were going to be a lot more deals at this point. I don't know. I haven't heard of that many that have taken place. So it sounds like another extension is in the offing.
It kind of has to, really.
There has to. And it's like,
but if not, I would expect we'll have more market volatility, right? Revisit what happened earlier in the year as if there's more like saber rattling, as it were. Whether or not that's how it lands, where things actually eventually end up, is probably, I think, a reasonable question to think, given what we've seen happen thus far this year. It does seem more probable that some of the initial rhetoric is a starting point to try to get positioning to end up with something that is still higher than where we've been, but not so high that it's implausible to have these trade agreements.
Yeah. I think the market is pricing in this idea that, Trump is not going to sit on his hands if the market starts getting extremely volatile. For better or worse, that's what the market is thinking from what it looks like. And, one thing I would just point to with that is, like, as these countries and as the markets sort of see that we keep getting an extension, how is it, like, more likely that we're going to get these deals done? Or is it like countries are going to be, thinking this is just going to keep continuing? We could just keep kicking the can down the road.
That's a good point.
So
the other concern I think you have is that other countries look to find alternative means of doing trade. And does that end up having longer term adverse implications?
Right,
for the
looking
US?
elsewhere rather than the U.S. If we're kind of not sure where we land on these different agreements, and if it becomes too difficult, It's natural.
On the positive side, I mean, I think there's been some positive conversations and general direction with the way things are working with NATO, which, I think that's unrelated to trade, but it's constructive. The worry that we might be driving a wedge between some of our allies in various ways that I think some of our adversaries would like to see. That this seems to be at least a point of progress and favorable outcome. Bring it back to the markets, though. Lots to consider, but let's go back to some of the portfolio indices. Let's more like think in terms of indices. How's performance done? The FTSE 100, which is UK, I think, 3.5%. The Nikkei 225 was up 8.4% year to date. I looked up what the All Country World Index did, based on the ETF, the iShares ACWI ETF, 9.45%, whereas the ACWI ex-US is up, again, iShares 16.8+%.
Those are pretty serious.
Seeing some pretty big returns from foreign markets in the first half of the year. Major differences in expectations. And some of this may have to do with what's happening with the dollar and how that plays into this. The other thing that's just when it comes to the U.S., if we break things down by cap weight, which you kind of made mention of looking at the style boxes, looking at the S&P indices, the S&P 500, 5.5% to the plus. The mid-cap index, the S&P 400, down about 0.5%, a little more, 0.58%. And the S&P 600, which is the S&P's small cap index, down 5.29%. So this echoes some of the things you mentioned, that we're seeing, very different kinds of returns in different parts of the capitalization structure. And again, I think this echoes some of the strategy that Brian has brought to the table when it comes to thinking about strategies we manage with discretion, that during the year, it became clear that with the way this was going to shape up, at least his view of it was that it was going to adversely impact smaller companies. Now, other people I heard argue, smaller companies do less foreign trade, therefore the trade issues shouldn't be as big an issue. But you've had more economic concerns, and that tends to be more difficult for smaller companies to manage or navigate. And I think, these days there are companies that are even smaller companies that have foreign trade consequences. So in any case, that was a good call and a good directional move to scale back on some of those smaller cap names and really emphasize the large cap. We've kind of had some emphasis in semiconductors and certain places of the market.
Mega cap just generally as the top, the largest companies. Brian was thinking, if based on last quarter's uncertainty, he was thinking if we're going to see outperformance, it's probably going to be in the large cap space, and it's proven to be true so far year to date.
So, despite us saying, I'm worried about this and that, we're seeing Brian having had some good decisions as it relates to some of the decisions in our portfolios. We don't particularly have emerging market exposure in most of our clients' accounts. That being said, the emerging markets were also positive, but modestly 2.8%. The real estate investment trusts, they're I'm not sure what index this is referring to. I think it's an S&P index, But in a case, 5.6% from REITs. The Barclays, the bond index, the Bloomberg Barclay U.S. Aggregate Bond Index, up a modest 1.9%. I think you'd expect less volatility by comparison to the way stocks move with the bonds. We have been generally positioned in a way that not only includes some intermediate term bond, but and a nice blending of corporates and government bonds. But we've been tilted toward some of the shorter duration perspective, which has given us a nice income with a little less risk, a little bit outperforming something like that aggregate bond index. The other place that a lot of investors have been talking about, we keep hearing a little more from clientele, is about gold, silver, the commodities. Those were positive, notably this year to date. Gold is up 7.25% or so. The silver is up 9.1%. That's one of those things that's challenging. We generally use commodities exposure as a tactical move, and there's specific drivers that will weigh into why we would do that. We can maybe talk about that more again in a future week, but I think the challenge, of course, is there's no earnings to look at. There's no clarity of what's driving that price movement. It's somewhat speculative in a sense, and that makes it a little more challenging to navigate. But think of that typically as more of a tactical position that can be worth consideration. And there are times, and we have in the past, and might not be something we'd exclude, but it's something we use selectively.
Yeah, I think gold, as Brian mentioned on a recent conversation with a client, was it's not like a company where you can do some like fundamental research. They're sort of invisible forces that are raising or decreasing the returns on gold specifically. I guess silver would probably be relatively similar. So because we don't have those insights into what is moving the needle there, even though gold has had this great run, it's not that easy to predict where it's going to go in the future.
Very true. So where's that leave us when it comes to, as we look ahead? It's a challenging time, I think, for investors to be clear about how to position their portfolio. By and large, I was reading an article. See if it was a Fortune article. Let me see if I can just put my finger on it while we're talking. And the topic was essentially this notion of, what do you do? How do you position things? Are you making, big changes in your portfolio? And the bulk of the commentators, the various advisors that were quoted, were pointing to the fact that a lot of times the best days follow the worst days. And, it's one of those scenarios where you're generally best served to stay the course.
Yeah.
However, it is a reasonable time if you're thinking, I don't have the appetite or should I review my asset allocation? When markets are at or near highs, it's a great time to revisit. Do I want to endure volatility as I look ahead? How do it to the same extent I've had in the past? Should I entertain any kind of, is it at that, am I at that point where my appetite for risk has declined? Instead of having this allocation, should I have a different allocation?
Yeah, I think it's easy to get stuck in the thought of like, well, I might miss out. It might keep going higher. But if you feel that like, you're at a stage in life where you don't need to be taking on that much risk, your plan works without taking the risk that you're currently at, and it feels, that volatility could be ahead, then it's not a bad time to look at moving to a lower risk allocation.
Excuse me.
Yeah, I think you've mentioned it to clients as well recently. Here with what's going on, the market seems to be unstoppable right now, and there's still a lot of uncertainty. We talk about it in episode after episode, AI, everyone is putting all their eggs in the AI basket. And of course, it is going to be a disruptor. It seems like there's no doubt. But how long that might take is a question. How much it costs is a question. There are a lot of things that need to go right for us to maintain these valuations and to keep pushing them higher.
So I think the point is not that things can't go well. The reality is that there will be volatility.
Yeah.
And if that's the reality, just that's the nature of equity investing. We want to come back to that notion of control the controllables. We had a recent seminar last month where there was a slide we used that was a great depiction of this. There are only so many things you can control. You can't control who wins an election or who doesn't. You can't control whether the tax legislation passes or doesn't. What happens with global trade? These are things that are a little outside our own control, right? Now, perhaps with your portfolio manager, you might want to have someone who has a sense of how to navigate those kinds of issues, have some active management that can assist you in that process. But for most investors, they're best suited to think about, a few key considerations that they can control. One of those is, what's my tolerance for volatility? How much equity exposure am I willing to have in my portfolio to endure these kinds of moves? Do I have tax diversification? Am I, not just all in a retirement account where, Uncle Sam's got his hands on 30% of my money? It's not all mine. Or whatever, 30, 35, whatever the number really is, depending on your tax bracket. When can I turn on things like Social Security or pension decisions that I make? These are things that, will have real impact on your financial planning forecasts that you have control to decide, when do I do these choices? And really even the retirement, when do I start that process? Or if you haven't yet retired, these are things you can control. And one of the big things is to keep a perspective. What's it all about? What's it all for? It's not about accumulating the biggest pile of money. It's about providing you a lifestyle, providing you a means to what's important to you, what really is your driver. And with a financial plan, you can do stress tests to say, what if the market declines 20, 30%, whatever it is? How does that influence the probabilities of success of my plan? What if taxes go up, Social Security goes down, inflation is higher? Fill in the blanks, right? This is something we can take a look at and say, should I be anxious or not? Should this alter the way I think about my portfolio? And that can be things that we can really control. And some of these other things, as much as we can't control them, again, I think we would encourage you to think in terms of working with a professional portfolio manager to assist you, so that they are able to help do some active management in the process to navigate some of these challenges that inevitably come up from time to time, whether it's valuations that we're looking at and questioning, whether it's trade issues, monetary policy, inflationary concerns, fill in the blank. These are all variables that it might have influence on how we want to position a portfolio, not necessarily that it's going to drive us to be all in or all out of the market or something, but it might flavor the composition of the portfolio. And that might be where you benefit the most from getting some help.
You were mentioning the financial plan, and I think as Chris was saying, it could be a good time to take a look at your risk tolerance, see how you're feeling about where you are in life and what stage you are in life and how much risk you want to take on. We can see in your financial plan the probability of your plan, lasting your finances lasting your whole life, given different scenarios of your risk, options. So you could have less stocks, see how that looks, and we can play all of those scenarios out to see what that would look like.
So keep us in mind if you'd like to get a little bit of help in the process. Now is a perfect time. Markets are at or near highs. It couldn't be a better time to get a second opinion on your portfolio and make sure that it works well with your financial planning needs. Happy 4th of July. Be safe. And until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.